हरे कृष्णा। एक बार फिर से स्वागत है आपका मेरे इस चैनल पर्पसफुल प्रॉस्पेरिटी पे। तो हम कंटिन्यू कर रहे हैं अपनी रीडिंग सीरीज द लिटिल बुक ऑफ कॉमन सेंस इन्वेस्टिंग, द ओनली वे टू गारंटी योर फेयर शेयर ऑफ स्टॉक मार्केट रिटर्न। टुडे वी आर ट्राइंग टू गेट द इन्वेस्टमेंट विजडम फ्रॉम चैप्टर नंबर 2 named rational exuberance, where they are trying to explain that shareholders gain must match with the business gain. So when the stock market temporarily overperform or underperform, the business, a limited number of shareholders, either shares, sellers or buyers, receive the outsized benefit of the expense of those trade with. So we really need to focus some of these important words from Warren Buffett. So he's saying that limited number of shareholders. And if you are thinking that you are those limited numbers, and based on that, if you are making your investment decision, then I would say there are high chances that we are going to fail. First of all, a retail investor is not having that vast level of details. If you take an example of Warren Buffett, the percentage of shareholding he's having for an Apple share, he can definitely give a call to Apple share CEO, and he can get some information, or he can talk about some business things which retail investor like you and me will never able to do that thing. So we have to understand that these outperformance, overperformance, and getting huge benefits is possible only with limited number of peoples. A retail investor will not be able to do these things. And we have to understand, if a retail investor is doing this thing, then there is another retail investor who is going to lose the equal amount, because we understand previously that it's a zero sum game. So we really want to uh, be intelligent investor, so that we understand and we know our limitation, that we are limited. We have limited resources and limited information. And based on that only, we need to make our investment decision. Then further, Warren Buffett says that over time, the aggregate gains made by shareholder must of necessity match the business gain of the company. So that's very important. So here you really need to understand that, but in a long run, everybody can get the same benefit which the business is gaining or the company is gaining. So in a long term, everybody can be a winner. But in a short term, only a limited person can be a winner. So that's the $1 million advice from Warren Buffett. He continues to deep dive in the chapter. So here on the right side, you see a graph where 116 year of history is being shown. That's a very, very long history. I think our Indian markets don't have that long history, but we can take advantage of the long history of US market. And here you can see that there are two graphs. If you see the dotted line graph, which is called the market returns, which includes your speculative returns, and the dash line, which is having investment return, which is normally the earning and growth yield plus dividend yield. So we really can see a very strong correlation between both of them. There are sometimes there is some diversion between the two, but that's for a very short duration. But in a long run, we have to understand that the investment return on a stock market tracks closely with the total market return over a long term. And this 116 year of data is also giving you information that the speculative return is adding just zero point 0.5 percentage points of the annual investment return earned by the businesses over the long term. So if a person is really planning to time the market, and if he is able to time that market for 116 years, then also he's going to get only 0.5%. So can you think of it, that how lucky will be that person, or how he's betting everything on his luck? 116 years, and every time he's lucky, and then what he's gaining just 0.5% extra. So what is the advantage of doing that exercise where you are sure to fail? So my dear investors, don't make these mistakes. look at this data and trying to get some more insight, feel free to pause the video, look into this graph, and try to understand this yourself. Let's just continue. So, in this chapter, Bogle gives a very nice quote from a great British economist, Mr. uh, John Maynard, where he's saying that to apply the future indicative argument based on past experience, unless one can distinguish the broad reasons why past experience were what it was. See, this statement is very well applying to retail investor who always buy mutual funds based on their past performance. So we look at the data and we look at the past year performance, sometimes the long term performance also 5 year, 10-year performance, but we don't know the reason why it has performed in those last 10 years. I think most of the retail investor doesn't know that. If I take any fund and say, okay, this fund has given in last 10 year 20% return, and if I ask them the reason that why it has given 24% return or 20% return, they will not be able to answer. And since they don't know the reason, and if they are blindly investing, then that's called speculation. And definitely, if you are doing speculation and you don't know the reasons, then there are no surety about your future returns. And that's where most of the retail investors get frustrated and they almost invest in a best performing fund. And in a very short period of time, that best performing fund become the worst performing fund and they need to exit. They need to incur losses and they are not even able to beat the FD returns. So, so all of them are getting a really bad taste. So I think that the statement by Mr. John is very important. So when we see we are looking at this data. So in the previous graph, we have seen this data of 116 years, but in the continuing in the chapter, Bogle is going to explain us the reason why this is. And then only he's saying that since we understand the reason, we can also say that in the future, the same thing is going to happen. So that's the beauty of Mr. Bogle in this chapter. So here he's saying that total market return depends on mainly two things. So one, you have your investment return, which is again the dividend and the earning growth, and they are remarkably steady over a long period of time. And then you have speculative return, which is the impact of changing price or changing the price earning multiples on stock prices. So, and this will not be steady. So maybe a couple of years you see a very high earning, very high PE ratios. That's because everybody is very greedy. And when there is a hope of growth, then you see an average price earning ratios. And when you see a fear, you see a very low price earning ratios. So, so they are not steady and they are going up and down. And then Bogle is further saying that despite the huge impact of speculative returns up and down, during most of the individual decades, there is virtually no impact over the long term. See, there are chances that maybe for a 10-year, you can remain on a high PE. And there can be a 10-year, you will be continuously down on a low PE. So I think there are many real investors who buys based on PE ratios. My dear friend, there are chances that you will be wrong for a decade. You'll be wrong for a year of 10 years. And I think nobody will have that long holding period when they see that they are getting wrong for a 10 years. So we really have to understand that PE can have a very long term impact. But maximum it can be for a decade. But if you look at the very long term, when we talk about like 30, 40, 50 years of investing, then I would say this is having a very insignificant effect. We have seen from the graph previously that it's just 0.5% in a year of 116 years. Then further, he's saying that in the long term, the stock returns depend almost entirely on the reality of the investment return earned by our corporates. So whatever our corporates are earning, in a long term we are going to get the equivalent. There is no space for your speculative returns. And then the last point, he's saying that accurately forecasting the short term swings in investor emotions is not possible. But forecasting the long term economics of investing has carried remarkably high odds of success. So that's very important. So if you see nowadays, everybody is saying that if you look at the many investor professional, I don't want to demean anybody, but I think all of their viewers come and they ask the same question. Sir, where is Nifty going next month? Sir, where is Sensex going in the coming week? And they give different sort of analysis and then they try to predict something. But here, Mr. Bogle is saying that in these short-term swings are not possible to forecast. So we have to look for a long-term solution, which is the corporate earning growth plus dividend. So that's what our earnings are, and that's what our return on investment is. Then Bogle is further saying that even after more than 66 years in this business, I have almost no idea how to forecast these short term swings in investor emotions. I have been able to forecast the long term economics of investing with remarkably high odds of success. See, such an intelligent investor, and he is admitting that in last 66 years he is not able to find these short term swings. Then do you think any newcomer who is experienced with some 5-10 years in the investing, having some courses on the internet, having some followers on their YouTube channels, will they able to tell you where the Nifty or Sensex are going to be in a short term? I would say no, friends. They are simply guessing. Half of them are going to say it's going to get down. Half of them will say it's going to get up. Definitely, one half of the person is going to be true. But I would say I think that's not their knowledge. That's just a speculation. And we don't, intelligent investor don't invest based on speculation. But in a long term, he is saying that the success of guessing where the market is going to be is very high. So now you need to choose whether you want to be play, you like to play a winner's game or you like to play a loser's game. The choice is up to you, investors. So be careful. And then further, he's adding that I am not alone. I don't know anyone who has done so consistently, nor even anyone who knows anyone who has done so. In fact, 70 years of financial research finds no one who has done so. See, such a large data, his own experience of 66 years and a data of 70 years of financial research, both are proving the same thing, that you cannot forecast the short term swings. So, intelligent investor should only look for long term economics of investing, and that's where your chances of success are very high. Then Bogle further adds that while illusion, the momentary prices we pay for the stocks, often loses touch with the reality, which is the intrinsic value of our corporations, it is reality that rules in the long run. So, whatever your earnings and your dividend growth we are having for our corporates, that is what our return is in a long term. Then Bogle further adds that the expectations market is about speculation. The real market is about investing. And we want to be an investor here, not the speculator. So he is finally concluding that the stock market is a giant distraction to the business of investing. So that's a very important uh, a point I would have to say, because I think most of us or retail investors who comes newly in the stock market, they always look for different stock market. They try to follow the stock market. They try to follow some stock market gurus or some stock market news channels, and based on that, they will say they want to learn investing by watching a stock market channel. But unfortunately to say, as per John Bogle, that's the giant distraction to your investing journey. So if you really want to become a good investor, then I would say avoid all that distraction and focus on the business of investing. So that's the advice by Mr. John Bogle. And then finally, he's concluding the chapter with some couple of very important advices to the investor. And he is given an example of Warren Benjamin Graham, where he's seeing that in the short term, market is a voting machine, but in the long term, it is a weighing machine. And that weighing machine is going to weight your dividend return and your earning growth. So the company which is making high dividend and the high earning growth, that's the one going to create you the huge wealth for you. So in his advice, he's continuing that ignore the short-term sound and fury of emotion reflected in our financial market and focus on the productive long-term economics of our corporate businesses. And then he's adding the second point where he says that the way to investment success is to get out of the expectation market of stock prices and cast your lot with the real market of business. Then he's further continuing with the Benjamin Graham quote that the true investor will do better if he forget about the stock market and pay attention to his dividend returns and to the operating results of his company. And I think that's what retail investors are making. That's where retail investors are making the most mistakes, where we always look for the stock market prices. We look for the prices of the Nifty. We look at the value of the Nifty and Sensex. Individual stock investor look for the value of the price of their stocks. But that's not where we are paying our attention. We should be paying our attention to, okay, what is the dividend return from that uh, index or the stock, and what is the operating profits. Those are the thing which is going to, that's where we should be paying the more attention. But then retail investor is doing the exactly the opposite, and that's the reason that we are never able to become an intelligent investor. So let's just try to get this knowledge from some of these, I would say, a big shark in the investment world, and get their vast and intelligent knowledge. And we imbibe that knowledge in us by reading through some of these, by some of excellent books which they have written for common retail investors. So let's just read them and try to get the maximum wisdom out of those things. So once again, thank you for watching this channel and for being with me for such a long time. Uh, we'll continue to read this book further. If you really like this kind of a content, if you think it's going to add some value to you, feel free to like, share, and subscribe to my channel, Purposeful Prosperity. And once again, thank you, everyone. Hare Krishna.